Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching Easynomics. The third quarter GDP numbers for the current financial year are just moments away, and all eyes on whether India's economy picked up pace after that rather steep slowdown in the second quarter. Various analysts expect the economy to rebound, driven by strong rural consumption, government capex that seems to have picked up after the election lull, and overall industrial activity, but urban demand and private investments continue to remain a concern. Meanwhile, a new World Bank report has highlighted that India needs to grow at an average of 7.8% annually to achieve high income status by 2047. Will India, at least in this third quarter, stay on track towards this goal? For answers on that, I am joined by Rumki Majumdar, economist at Deloitte, Madan Sabnavis, chief economist at the Bank of Baroda, and Vivek Kumar, economist at QuantEco. Madan, coming to you quickly, what number are we likely to see flash on the screen in minutes from now?
In fact, we are quite optimistic. We're looking at a number of 6.6% for Q3, because if we have to reach the number of 6.4% for the year, which was the first advance estimate, which may go in for a revision today, I think we need to be registering over 6.5% in Q3 and Q4. And since we do believe that for the full year, the growth would be in the region of around 6.6%, I think 6.6 is what we're betting for.
Viewers, I'm keeping an eye out for the first flashes on that, but that same question to you, Rumki. What's the number that you will toss into the mix?
I'm also quite optimistic. We are kind of predicting around 7% growth, because we looked at all the high frequency numbers. The consumption growth has been in the FMCG sector has been good. Government capex has gone up. We also looked at the number of the tax filing that has happened. It has also actually grown this fiscal year. So clearly there's a lot of signals that saying that the consumption probably will be stronger this quarter. Plus it was a festive quarter, so we are hoping that this quarter will hold up pretty strongly this time.
Vivek, what's the numbers that you are penciling? All right, we'll go across to Vivek as soon as we have him. But Madan, taking that point forward, an uptick in growth, if it were to come through in the Q3 numbers, what does it imply for the full fiscal?
So I think it's imperative that we should be having a good rate in the third quarter if we have to reach now.
Okay.
We're also going to expect it in Q4. I think when we are talking of Mahakumbh, but the kind of population which visited this place, the kind of expenditure which must have taken place, I'm not talking of the capex, I'm talking just in terms of the consumption expenditure taking place. If 600 million people did congregate there during a period of 45 days, things should have been very good in terms of overall spending. This may not, I'm not quite sure how this gets captured in the GDP numbers. A lot of that would be in the unorganized sector where the spending takes place. But the general thrust will definitely be seen in terms of both consumption picking up. And another point I'd like to add here, Siddharth, is that if you're looking at the investment announcements based on CMI data, they've been quite stupendous starting from July onwards, right up till February 27th as we speak. So I think there's a lot of intent which is there even for investment. Of course, we need to see how much of that materializes. And given the fact that the government is probably in the last leg of meeting its capex targets, I do see positive signs in Q3 as well as in Q4.
Vivek, if you can hear me, the question, are you expecting a moderate acceleration?
Right, Siddharth. Absolutely. So we are penciling in somewhere close to 6.5% on the GDP. So that will be an acceleration vis-a-vis a 7-quarter low figure of 5.4% that we saw for Q2. And to a large extent, as you rightly summed up before asking the questions, that there has been a perceptible amount of uptick in government expenditure. The Kharif produce is now looking somewhat healthier. And last but not the least, I guess there is also some degree of comfort that the rural economy is now outpacing the demand side of the equation as far as the urban economy is concerned. So these are the three key pillars which make us feel that there will be a more moderate acceleration in Q3.
Okay. Rumki, the fact that the numbers are out likely any time soon, practically seconds away. And before I go to you, I just wanted to also draw attention of all of our viewers towards the rupee falling 28 paisa to close at 87.46 against the US dollar. If you take a look at the markets and what happened on the broader indices today, continuing mayhem, a broad sell-off sea of red on the screen that we saw through the day, and clearly as far as growth is concerned, the growth momentum recovery should feed in perhaps as from a fundamental point of view on the markets, although this biggest intraday drop that we have seen is very clearly signal that the markets are feeding on fears perhaps of what is likely to continue as far as Trump tariffs are concerned, and what is also likely as far as fund flows particularly of FIIs are concerned. Some nervousness now also creeping into the SIP space which has held up our markets. But from a broader point of view, Rumki, how should market participants look at this GDP number from an overall economic growth perspective? India GDP at 6.2%. We have the number now. The GDP number has come in at 6.2%, and clearly several State Bank of India had predicted 6.2%, Nomura had predicted 6.2%, but breaking news on the screen, viewers, Q3 FY25 GDP October to December quarter growth has come in at 6.2%, and this, if you compare with the same period a year ago, that was 9.4%. Quarter on quarter basis, of course, from 5.4 to 6.2, but if you look at it in YOY terms, it is at 6.2 versus 9.5% a year ago. The government has also hiked the estimate for FY25 GDP growth to 6.5% now from 6.4% earlier. So the second headline, 6.5% for the full year. GVA growth for FY25, remember I'm talking about full year numbers, at 6.4% as per the second advance estimate. So just to recap, third quarter at 6.2%. We have third quarter GVA growth at 6.2% versus 8% a year ago. FY25 GVA growth at 6.4%, and the full year number revised just marginally up to 6.5%. We now have the components which we will start bringing up on the screen. Agriculture 5.6% versus 1.5% in the same period a year ago. So agriculture clearly for our panel of experts to absorb. 5.6% farm sector growth versus 1.5%. Mining sector growth down at 1.4% versus 4.7%. All of these are annual year on year numbers, not quarter on quarter. There is no trailing number that I am talking about right now. Manufacturing at 3.5% versus 14% a year ago. So we have the numbers for the farm sector, for the mining sector, and for manufacturing. Right now we have construction sector growth at 7% versus 10.1%. Again, third quarter numbers on a YOY basis. So four key components of GDP: farm, mining, manufacturing, construction. We are clearly seeing, except farm sector, the remaining three down on a year on year basis. Agriculture sector, good news. Services sector growth numbers now in 7.4% versus 8.3% a year ago. So services again 7.4% versus 8.3%. If you look at the numbers, it's clearly we now have the number for nominal GDP growth. The third quarter nominal GDP growth number being pegged at 9.9% versus 12.9% YOY basis. This is the nominal GDP growth number being now released at 9.9%. April-June GDP growth has been revised to down to 6.5% versus 6.7%. Let me read that out for our viewers once again. April-June GDP growth, which is the first quarter of the current financial year, that has been revised downwards by 20 basis points to 6.5 versus 6.7. July-September GDP growth has been revised upwards by 20 basis points to 5.6 versus 5.4% a year ago. The April to December 9-month period growth at 6.1% versus 9.5% a year ago. For the same 9-month period, GVA growth again at the same 6.2. However, GVA for the same period a year ago was 9%. Madan, quick reactions to all those numbers that you just heard.
I think there have been quite a bit of revisions which have taken place in the first two quarters, including the last year also. So it becomes slightly difficult to keep interpreting these numbers. But suppose we start off, say, with the revised GDP number for the year, which is we put at 6.5%. So this would necessarily mean that we will have to have a very high growth in the fourth quarter, probably closer towards the 7% number. I think that's my first impression based on numbers which you have put out, because for the Q3 number at 6.2% is definitely much lower than what all of us on this particular panel had expected. So I think that's come as a kind of a disappointment. But part of this is also because of the revisions which have taken place in the previous year.
Rumki, your quick comment on this number, and let me also read out a couple of more data points that have come in. October-December private consumption growth at 6.9% versus 5.7%. We also have the fiscal deficit at 74.5% of the revised FY25 target. But Rumki, agriculture seemed to be a clear a winner as far as this set of numbers is concerned.
Right. And as Madan also rightly pointed out, we were basing our quarter's growth basis because previous year's numbers have been revised up. So clearly that base effect has factored in. Agriculture is the strongest, and which means the rural demand will continue to remain strong. Manufacturing hasn't picked up yet, but the services sector remains quite strong. It is compared to what it has been performing over the last two quarters. So in a way, I think agriculture and services
Okay, I'm sorry to interrupt you. We have a headline number that's come in for FY24. The GDP growth number has been revised to 9.2% from 8.2% earlier. Vivek, I hope you were able to hear me. FY24 growth now at 9.2% versus 8.2% earlier. I did a double take and was trying to be very sure that I don't get it wrong, but I can assure you that the flashes that are coming in our wire services terminal, government hikes FY24 GDP growth to 9.2% from 8.2% earlier. Vivek, quick reaction to that.
It's a rear view comfort, Siddharth. We all know that there was a big rebound in the post-COVID numbers, and that rebound was also seen to a large extent in terms of corporate profitability. So whether it is 8.2, 9.2, I think the broader message here is that there was a big comfort in the post-COVID recovery. But more importantly, coming on to FY25, the current financial year, where you see the revisions playing out to some extent. So you could argue that 6.5% that we were penciling in for the current quarter, as in Q3, is somewhat in line with the unchanged numbers. So just because the base got revised, the numbers are now looking slightly lower than anticipated. The broader message, agriculture is doing a lot of heavy lifting, and so is consumption. So consumption also, I think the number that you quoted was 6.9% for private consumption growth. That is also doing fairly well. along with government consumption. So
In fact, Vivek, just to interrupt you, you made this point about post-COVID, and that is bearing out with the FY23 GDP growth number being revised to 7.6% from 7% earlier. I just also want to quickly talk about the government. So very clear signs, viewers, that government expenditure is now on a path to recovery as far as the third quarter numbers are concerned, because government consumption expenditure number, which was 2.3% in the third quarter in the previous year, is now being clocked in at 8.3%. So very clearly government expenditure going up, and the total expenditure for the April to January period of the government of India at 35.7 lakh crore versus 33.54. So there we can see an increase in government's expenditure. Receipts are also up, but government spending is up. In fact, the January capital expenditure data that I have here with me at 720 billion versus 476 billion rupees a year ago. We now have October December industry growth number, which had not come in so far, and that has come in at a significant increase of the number. Let me just get that out for you once again. Industry growth at 4.5%. I stand corrected, it is 4.5%, down from 12.2% a year ago. Rumki, quick comment on these numbers before I go to Madan, as we get more understanding of what seems to have happened.
So clearly from the demand side, I think consumption is actually holding up well, which is a very strong signal that now investments will pick up. And as we were discussing earlier, there is an appetite to invest, and now probably the consumption will kind of boost it. Government is also spending, so clearly there is a push from the government, and private consumption together should bring in more capital investments going forward. Industry has not picked up yet, and that is something which is a concern. But looks like I think it's a matter of time before investments pick up. So I think the next few quarters will be quite good. But last year revisions are quite up, so that's probably is kind of bringing down all the growth numbers this year.
From a components of GDP perspective, now that we have industry growth as well, Madan, what is the picture therefore that emerges from this data?
So on the picture, I think the picture which we're getting is like this, that one, we're looking in terms of the manufacturing sector. We know very well that the corporate results have not been that flattering, especially if you look at the growth in turnover and also in terms of growth in profits. So I think that's something which is getting reflected in the GDP numbers. On the other hand, if you look at the services sector, the three components out there, including the financial sector, we have definitely seen there has been greater momentum in this particular segment. So if you leave aside the numbers as such, which have been affected on account of the numbers of 24-25 being revised upwards, but the trend generally is agriculture doing well, manufacturing still under pressure, which we do hope would turn around. But this is something which was probably anticipated also. And services sector actually driving the economy. So I think this is the picture which you're getting in the third quarter, as well as for the full year, based on these forecasts.
Madan, quick follow-up. If agriculture is doing well, can I therefore ask you that does it imply that rural consumption will continue to remain strong? Because it's directly linked.
Yeah, we can expect that it will continue to remain strong, because I think the expectations are that the Rabi crop would also be very good, which means that rural consumption would definitely play its part. But we should also remember that for the economy to really fire, now when you mentioned about the World Bank report talking of growth being above 7%, 7.8% is what you mentioned. I think for that kind of thing, we need even to see the urban demand picking up. Now that's something which has been lacking, something which has been echoed by the FMCG companies also, that urban demand is something which has been under stress. But as we generally feel that, okay, things are looking better right now and things are going to improve. There's been some action taken by the government in terms of the budget. We have seen the interest rate cycle probably turning around in a more definitive manner during the course of the year. So we could be expecting even the urban demand component to pick up in the course of 25-26. So therefore, I think when we're talking of, say, the RBI's forecast of, say, 6.7% is what they've given. for the next year. I think that maybe looks something which could be very much achieved.
Vivek, would it be fair to assess the state of the economy at this point that the overall trajectory remains favorable? Our balance sheets, both in the banking sector as well as companies, are fairly robust. Government spending seems to have now started in real earnest after that election lull. Other parts of the economy are doing well, and inflation, barring some weather related shock, we seem to be having early summer, and that also has some impact, is on a moderate trajectory. RBI has also perhaps begun what could be a fairly decent rate cutting cycle. Would you agree with that summation?
Well, to a large extent, yes. So that's post-COVID, when things started to heat up a little bit, both monetary policy as well as fiscal policy started getting into a contractionary phase.
Vivek, I'm sorry I have to interrupt you. There's a correction that has been put out. And remember, I was faltering on the industry growth number. That correction has been put out just now. October-December 2023, industry growth is 11.8%, not 12.2%. So this is 2023. I correct, it's a double correction. It's not for the quarter that we were discussing, but for the previous year industry growth. But continue your point.
Okay, sure. So post-COVID, both fiscal policy as well as monetary policy was in a tightening phase. Deficits were getting consolidated from the fiscal side. The government expenditure as a ratio to GDP was tightened. And a similar trend was also seen in case of state government spending. Now, even on the monetary policy side, you saw a fair bit of tightening happening in a short period of time. Liquidity also started getting withdrawn. And it was natural to expect growth to come off its high. So even if you consider the revised numbers, so 8-9% is a high number for any economy, and for that matter, India. So from those high levels, growth has come off. Now, if one has to, let's say, ignore the Q2 GDP data, which was at 5.6%, and look at Q1 and Q3. Q1 and Q3 numbers are somewhere in the vicinity of 6.2, 6.6% range. Now, that happens to be a reasonably strong range or reasonably strong growth momentum for India, but it's not a momentum which is going to, put you in a higher orbit. You're probably running at a good speed, but the takeoff stage will only happen when you cross 7.5% rate. And I think that's something which the World Bank is highlighting, that you need to be closer to 8% to achieve all the Viksit Bharat goals that you've set out for yourself, 20 years from now.
Madan, just from a analytical point of view, you made that point earlier about revisions. Now, revisions keep happening because that's the nature of the data and the process of data collection and dissemination. I mean, it can't be real time, frankly. We could aspire to get there maybe 50 years in the future. But are these revisions something that bother you, particularly from the point of view of past questions that have been raised about quality of statistics that are put out?
No, I think it does bother me because, very often we come to these shows and we do make certain projections and certain assumptions. And when you suddenly see that the numbers have been revised substantially, especially going back 2 years, it definitely does put a kind of a shadow on the way in which we do our forecasting. Because all the forecasts which we make are based on the numbers which held until yesterday for 23-24. And now when 8.6 goes up to 9.2%, then evidently things have changed substantially out there. And therefore, our forecast of, say, 6.6% does look as if we were far off the mark. But that would be primarily on account of the fact that we were dealing with a lower base of 8.6%. So I think this is a major problem which is happening. Because we're having these forecasts. We're having the first advance estimate which came out in January, at the time when we had information maybe for around 7 or 8 months only. But I think the problem is that we needed to have these kind of estimates because when you're drawing up a budget, we need to have some fundamentals, some basic fundamentals of saying that how the economy has behaved in the previous year, on the basis of which a certain projection was made about how GDP growth would be around 10% when the budget was issued. So I think we have to
Okay.
live with it. But I think the worrisome factor is that if things 2 years back are being changed, then yes, it does make forecasting a lot more challenging.
Okay, I want to do a round of forward-looking comments from our three panelist viewers, and Rumki, I'll start with you. Basis these numbers, your assessment for the fourth quarter and full year as of now, if you are in a position to talk about that, and also a quick comment on what do you think this whole set of numbers, how will it feed into RBI thinking?
Okay. One good thing that the number was not announced was exports. If you look, the exports growth has been very, very strong. It's 10.4%. So clearly the economy has done well despite the uncertainties that we have seen, and maybe the currency depreciation that you were asking about has probably helped in boosting this exports. We feel going forward, I think given the consumption is going up, government is spending high, so there will be a lot of private investments now coming in. There is an appetite to invest. So if and going, looks like consumption and investments will be the strongest drivers going, given the global uncertainties that we are seeing. So we expect growth to be stronger in the fourth quarter. 6.5 would mean we have to grow around 7 or above 7% to get there. So possible, but we will see how quickly the investment picks up. Consumption is actually being very strong, so that's a good news.
Okay, Vivek, before you answer that very same question, just reading another set of not totally unrelated data, but February rainfall is 50%, above 50% below normal. If you look at east and northeast, it's 18.5% below normal. Northwest of India, almost 51% below normals. Peninsular South India, 84.2% below normal. Central India, 82% below normal. Vivek, I just thought I will add this element also, because we are seeing how the temperature gauge is behaving. The spring came and disappeared, at least in the north. What would you say we should be looking forward to?
So these numbers are pretty stark, so that no doubt. The only comfort that one could probably take from a statistical point of view is that the share or the weight of, let's say, months of January and February in the overall precipitation levels is fairly small.
Yes.
So put together, if I can probably say January and February, they have a weight of about 3.5% in the total monsoon that India receives in the entire calendar year. So the share is small, so the impact is not going to be huge. What probably needs to be monitored more closely is how the temperature levels are behaving, and the kind of cautious warnings which are coming from the IMD gives you a sense of discomfort. So, for example, what we see on the ground is that the temperature levels have been almost 0.5 to 1 degree centigrade higher than the long-term averages. And it's more pertinent in case of the minimum temperatures than the maximum temperatures that were recorded during the day. So which is not a very comforting situation for the Rabi crop outlook. But these are early days, so you still have a month of data to analyze and see what kind of impact it might have. And temperature or the weather patterns can change drastically within a week's time. So
Absolutely.
as of now, probably it's something that needs to be kept on the table as far as monitoring is concerned. Would not put it as a red flag, but definitely something which needs to be closely monitored.
Madan, closing comments from you, and also in the context of the overall strategy that the government is likely to follow, and the indications that the Reserve Bank has given us, what kind of policy action should we be looking forward to in the next announcement?
Yes, what Rumki mentioned, I think we would be expecting growth above 7%. In fact, my calculation shows it should be 7.4, 7.5%. And that may be a bit difficult, I think. So maybe the 6.5 may just go back to 6.4. So we'll have to see how that thing works on. The second part is what you mentioned of the monsoon. I think that's quite significant because while most of the sowing is done and should not be affected by the rains, but I think the allied activities is something which tends to be affected more in case there are the water table levels come down. So I think that would be a concern. So the kind of numbers which we have seen for agriculture is something which we'll have to see whether it can be maintained in case there are any adverse repercussions there. Now, in terms of government policies, I think it's already been spelled out. And if you look at the face of it, when the budget was announced, when monetary policy was announced, I think we were looking at GDP growth of 6.4% for the year. So that's become 6.5. So we're assuming it's in this particular range. So I don't think there'll be any other change. And I don't think these numbers show any worry as such, any specific sector where there needs to be attention paid. I think the only one would be, of course, on exports, but then that is something which is exogenous to the system. It's not something over which economic policy from the point of view of the government can work on. So I think they will continue to try and do whatever is possible in order to make sure that exports go up. But no specific change in direction is what I expect from both the government as well as the RBI.
All right. So very clearly, viewers, for many months, a while ago, we used to be talking about rural distress, but today, if one were to try and capture these numbers in a short headline, the talk about rural distress is long in the past now. In fact, rural is what seems to have led to an improvement and acceleration along with government spending coming back, and that should provide support to growth at a time when the markets seem to be in a completely different mood, down 2% today and no relief seen at least in the near term, and perhaps that will be a bigger point for investors. But those of you who are looking at the market in fundamental terms, India's economic growth seems to be on fairly even footing, and revisions of the past have pegged these numbers even higher, but it's clear that government will continue to have to do the heavy lifting. Madan, Rumki and Vivek, thank you very much for your time with us today. With that, it's a wrap on this episode of Easynomics. We'll continue our coverage. See you on the other side very soon.
Hello and welcome to Business Today's Banking and Economy Summit, Best Banks Award. I'm joined by Sanjay Doshi, Partner Financial Services Advisory Leader, KPMG in India. Hello sir, pleasure to have you here.
Hi.
Sir, I want to start by asking you that the interest rate cuts, what sort of an effect can it have on the banking sector of NIMs?